Flying high above the metropolis, it's the Roth Guy with holistic wealth advisor Jude Wilson.
Well, we're back for a new episode of the Roth Guy, and we are into the new year. Jude and I are going to talk about some things to think about for the new year, Jude, right? So maybe kind of some tax strategies, some things, just a checklist, if you will, of some things to run down as we are getting into 2025, which just sounds weird. How you doing?
Outrageous, right? I'm doing great, man. I'm back from vacation. I feel energized. I'm ready to rock and roll.
There you go. Well, we're going to have a download to give away this week on the show. So go to thetaxbomb.com and then you'll be able to go to the Roth Guy or the resources tab there, and you'll be able to scroll down. We'll put a link in there for you. But we're going to have important tax numbers 2025 PDF for you guys to download and check out. And we're going to talk about that a little bit on the show as well today. So we'll run through some of that stuff, but go check that out if you guys need that. And again, we'll have that in the show links. So I guess, buddy, let's just start with a recap of last year. I just saw numbers that popped up that said that the S&P finished at 20+% for the second year in a row, 2 years in a row. Last time we had that happen was right before the .com burst. All
right, you'll jinx us now.
I know, right? 99 and 2000 was like the last time we saw that. So what's your thoughts?
Look, the last 2 years, there's no doubt it's just been incredible for investors. And I feel bad for some people who, during the COVID years, they became very conservative and they didn't have a financial advisor to guide them through proper allocation. Yeah. And this is why we stress so much the bucket plan, making sure your assets are allocated correctly in the three different buckets, but also your investment allocation, because as you said, this doesn't happen all the time. And if you miss the run up, man, your overall returns drop dramatically. So those of our clients that are well invested, I think they're very happy. People who maybe miss the rally, people tend to buy in at the high and then sell at the low.
Yeah, we all want to get in on it when we see it's been doing well for a while, and then when it's like, well, you're going to be a little shorting yourself a little bit. You're still taking some action, which is good, but at the same time, you got to have some understanding of what's going on and some proper expectations. So some lessons learned from the recap of last year, Jude. Market performance, we just said, was great. So we were all wondering what's going to happen with the tax laws, right? Yeah. So once we got the election over with, and we'll be getting a new administration here pretty soon. The time we're taping this, the administration won't have yet taken over, but we think, again, nobody knows for yet.
Nobody knows.
A week or two to find out, but we think they're going to try to at least extend the TCJA, which would not make a huge amount of changes to the tax law. Again, they could make some new ripples. We'll see. But for the most part, what do you think about keeping the tax rates the way they are?
Yeah, I think it's highly probable. One of my old professors at FSU used to say, there's a difference between probability and possibility. Anything is possible. Your job is to figure out how probable it is. Okay. And I think it's very probable that the current tax rates will stay or extend past
at least,
past the deadline where they're set to expire. But that still gives us a lot of urgency around looking at people's total allocation as far as the tax efficiency of their accounts. Should we be doing Roth conversion? Should we be putting more money in the Roth side versus the traditional side? Yeah. Just because it's extended doesn't mean the math on the deficit hasn't changed. We were trying to get proactive instead of being reactive.
Well, that's a good point, right? Because they were going to end, or they still could. Again, we could be wrong, but with them having control of everything, with the Republicans having control of everything, the likelihood of them doing some form of extension is pretty good. It's pretty high now, because they were going to sunset, as we've talked about a million times, at the end of 2025. So if you were thinking about Roth conversions, your window got really short. But if they do extend it for whatever it is, let's say it's 3 years or 5 years or 4 years or whatever, it does give you time now to start Rothing over time, which could be a very valuable piece. However, like you said, don't wait and then something changes, right? So just because they extend it doesn't mean, well, good, I bought myself another 2 years before I start this. Just get started.
Well, this goes perfectly into what we wanted to talk about today, being proactive, learning some lessons from last year, and how can we start the year being proactive in our own financial planning? So, man, what a segue. You must do this for a living.
Something like that. Well, let's run it down, right? So we got some key financial tips to start the new year. Give us number one. Let's break them down.
Well, first of all, let's look at your investment portfolios. And I break it down into two segments. You can look at your retirement accounts, and your retirement accounts are tax sheltered. So we're going to set that aside for a second. Your non-retirement accounts, your brokerage accounts, your savings accounts, your CDs, all of those type of things that you're going to get a 1099 for at the end of the year. You should be receiving that in the next few weeks. You really need to take a look at that. And here's the reason why. Any investment that you get a 1099 for could be adding unnecessarily to your tax burden. You'll see in the 1099 how much was paid in capital gains, how much was paid in dividends, and how much was paid in interest. And oftentimes I meet clients who they're not living off of their portfolio. They don't need their portfolio currently to provide income.
Right.
But when I look at their tax returns, I see they've got a lot of dividends and interest that were paid. And this is money, if it was allocated differently, would not contribute to additional tax burden that they have to pay. So I strongly recommend definitely take a look at your 1099.
Yeah, and you could find some areas to maybe reduce taxable gains, right? Portfolio turnover. Those are some things that we could certainly think about. And speaking of portfolio turnover, Jude, what's some things to think about there, right? So the ratio on that, right?
Yeah, and again, we're talking about your non-retirement accounts because if you're tax sheltered, you don't have to worry about that. But in your non-retirement accounts, often people are in mutual funds, or they have a portfolio manager, or they may be doing their own investments. And they don't realize that every time I sell a security, if I've made a gain on that, that could cause additional tax burden. And so in the industry, we have something called portfolio turnover. And a portfolio turnover of 1 means that basically you've turned over that portfolio 1 full cycle. You've sold everything in there. And so if you're trying to be tax efficient, you definitely don't want something over a 1. You need to check with your mutual fund companies. There's usually a report where you can see your portfolio turnover. And it's all about being tax efficient, because at the end of the day, it's great to get 20% returns, but it's what you keep that really makes the difference.
Yeah, that's a good point too, and some good information in there for folks to think about. So we want to think about the portfolio turnover, keeping those costs down, being tax efficient, and all of that. So new year. Contribution limits, are we bumping these up? Where are we sitting? What are we doing? Especially if we're still working, right? So what are we doing as far as socking some money away for the future?
Yeah, new year. And that's why it's important to go to the resource tab and download important tax numbers for 2025. Previously, you could contribute up to $23,000. In 2024, it's been bumped up to $23,500. And there's been some other changes that have been made. So you really want to set your savings goal for this year to match the opportunities and the changes that have been made. And you can double check that by looking at the PDF that we have.
And again, you can get that downloaded. So what are some of the key takeaways? Just a couple quick things to highlight for folks.
Yeah. One other thing people may take a look at, whether you're in retirement or have parents that are in retirement, is RMDs, required minimum distributions. They are calculated based on the balance of your retirement accounts on December 31st. In the PDF, it shows you how to calculate that based on your life expectancy in the IRS tables. Okay. And the really big thing is qualified charitable distributions, QCD. A lot of people don't know that your RMDs, of course, is taxable income. But if you're charitably inclined and over the age of 73, you can send some of your R&D money directly to the charity and avoid taxable income. And the reason we bring this up now is because sometimes people make a mistake and they take their RMDs, they want to claim QCD, but they claim it after they've already taken their RMDs. And that's a big mistake. You'll miss out on the opportunity.
Yeah. And, so that's an opportunity to do, you've got the whole year. There's the max limit of like 100,000 or something.
Exactly.
Yeah. So, if depending on your, how charitably inclined you are and how much your RMDs need to be, and what you if you need the money or don't need the money, right? So people, because it's so funny how many people are like, I gotta take that. I was just talking to somebody the other day, Jude, and they were like, I can't stand the fact that my advisor makes me take these distributions. And I said, well, you might want to pump the brakes on the fact that your advisor makes you. It's your uncle that makes you.
Yeah, Uncle Sam, he's in the
Uncle
pocket.
Sam makes you. Yeah. They're just trying to keep you from having penalties and paying extra issues. So yeah. You got to do those things for sure. So that's some good stuff. What's some other savings opportunities? How can we maximize some stuff, Jude? What's some other things to think about?
Yeah, we definitely want to think about the balance between if you're still working and contributing to a 401k or some type of retirement account. I've got clients all the time that say, "Oh, I'm maxing out the Roth side of my 401k," and I say, "Wait a minute. You may want to figure out how much should be on the traditional side because you get a tax deduction for that versus
Okay.
how much should be on the Roth side." It's like baking a cake. You got to have the right amount on each side to get the biggest bang for your buck. And most people don't know that.
Let me ask you about that because, like, depending on your earnings income, right? So some people are like, "Hey, I know we talked there with a Roth guy," and so naturally it would be like, "Well, shouldn't I just go all Roth?" But if you need the income adjustments, right, because you want to kind of bring down your taxable income, maybe the traditional is important as well, right? Is that balance you're talking about?
That's exactly the balance. And we've talked about this on previous episodes. We use something we call the tax efficient funnels. It shows how much money should be in pre-tax, post-tax, and versus tax advantage.
Okay.
And we can calculate for individuals exactly how much should be in that pre-tax dollars. Because remember, when you retire and start taking income, you'll still have deductions to claim against that income. And so why not get a tax deduction today and plan for some of that income to be socked up by your deductions, when you retire? That's
Right.
the balance. There's a sweet spot there, and it's different for everybody.
Yeah, and so just as a reminder, and we've got those limits, we got that information in that PDF. If you want to check that out, but so single, it's what 150,000 to 165,000. Married filing jointly 236 to 246. So depending on your income levels, and it's easy to especially do for a married couple. If you're making decent money to hit these numbers, it may be worthwhile to look at. Also, HSA, Jude, that could be a good place for people to think about being tax efficient as well as it's a great tool.
Absolutely. The only triple threat in tax advantage. You
Yeah.
get a tax deduction for the contribution, it's tax sheltered, and it comes out tax free. So that's something we often talk about when we look at the tax efficient funnels. That's the third funnel, the tax advantage funnel. That's something we often talk about.
Yeah, so if you've got a player, on your football team that's that true triple threat, maybe they're a great running back and they're also a great receiver out of the backfield and they block really well, right? So they do all three of the things really well. There's not many that can do all that good
Yeah.
that stuff at an elite level, and the HSA is kind of like that. So
Yeah. Wish we had that guy at FSU, but that's a whole other story.
I hear you there. All right, what's some other tips to think about? As we're starting the year, again, that's the point of the podcast this time. Things to kick off, tweak out, this month of January. When it's a little chillier and maybe you're not doing as much stuff, go ahead and get some of this stuff knocked out and get it handled. So when the warm weather comes in, you can start rocking and rolling with the fun stuff. Insurance review.
Yeah, looking at what life changes have you had, and are your insurance policies reflecting those life changes, and looking at your estate plan. A lot of people don't have an estate plan, and some that do have never executed the estate plan, so it's not almost like not having one. So I think I would round out this conversation by saying there's a lot of things that you should be talking about, whether you're doing your financial planning on your own, whether you have another advisor, or you're working with us. We want you to be proactive. And now's the time to set the pace early in the year, create the benchmarks, create the goals, just like everything else that we do around New Year planning and all of the habits we want to change. The finances should be near the top of the list.
Yeah, I mean, think about most people are doing New Year, New Me, right? When the new year starts, and they're trying to lose weight or quit smoking or whatever it is. So financially usually is on that list as well, as I want to get right financially. So create an action plan. So we got a couple of steps here for you to create an action plan for 2025. Set clear, measurable financial goals, right, Jude? That's a good one. Increase retirement savings, another one. Reduce taxable income and optimize charitable giving. So there's 4 great ones right there. And you can even you can break them into like subgroups if you need to, right? But write it down and get some steps going.
That's for sure. And we're here to help in any way that we can.
Well, don't forget that if you need some help, again, reach out to Jude and the team. We have links in the show notes in the description below. Obviously, we always thank you guys for checking out the podcast. We've had some great numbers on some of the recent episodes, so thank you so much. Don't forget to hit the subscribe button on YouTube. That way you catch new episodes when they come out. Ring the bell for notifications. Give a little thumbs up and maybe leave a comment if there's something you'd like us to talk about in the future episodes. We're just getting rolling. I think this is episode 9 or 10, so we're just getting things going. We got the whole year, and there's going to be a lot, Jude, right? So with the new administration,
I'm excited about the future.
You know, the first 100 days that Trump, when he gets in, he's going to start writing some different things, some executive orders. They got a lot of plans. So there'll be plenty to talk about economically, I'm quite sure.
Yeah, for sure. We won't run out of topics.
No, for sure. And if you need if you do need some help, don't forget about that download we got this week. Again, check the show notes. We got links in there for you. Get that free important tax numbers 2025 PDF. We'll have a link for you to go to thetaxbomb.com, so you can click on that. And I think that'll do it, my friends. So have a great week. We'll see you next time here on The Roth Guy with Jude Wilson.
Financial planning and advisory services are offered through Prosperity Capital Advisors, PCA, an SEC-registered investment advisor with its principal place of business in the state of Ohio. Centrus Financial Strategies and PCA are separate, non-affiliated entities. PCA does not provide tax or legal advice. Insurance and tax services offered through Centrus Financial Strategies are not affiliated with PCA. Information received from this podcast should not be viewed as individual investment advice. Product discussions and illustrations are hypothetical in nature and will vary based on many factors, including but not limited to age, health, product, insurance carrier, and product design. You should consult the insurance carrier website and policy for detailed information. For information pertaining to the registration status of PCA, please contact the firm or refer to the Investment Advisor Public Disclosure website, www.advisorinfo.sec.gov. For additional information about PCA, including fees and services, send for our disclosure statement as set forth on Form ADV from PCA using the contact information herein. Please read the disclosure statement carefully before you invest or send money.